Most people don't learn a single thing about money until they're already drowning in debt, missed opportunities, and financial regret. But here's the uncomfortable truth. The habits you build, or fail to build, before your 18th birthday quietly shape the next 30 years of your financial life. This video isn't about generic budgeting tips, it's about why the clock is actually ticking and what the financial world looks like the moment you cross that age threshold. Most people treat turning 18 like it's just a fun milestone. You can vote, you can buy a lottery ticket, maybe you move out. But from a financial and legal standpoint, something far more significant happens on that birthday. You become a contractual adult. That means for the very first time, a credit card company can hand you a line of credit and legally hold you responsible for every single dollar you spend. Insurance companies can charge you adult rates. Landlords can run your credit. Employers in certain fields can check your financial history. The financial system essentially flips a switch, and suddenly the decisions you make have real, lasting consequences that follow you in ways they simply didn't before. Historically, this shift has created a predictable pattern. Study after study from organizations like the Consumer Financial Protection Bureau has shown that young adults between 18 and 22 are among the most aggressively targeted demographics by credit card companies. Why? Because statistically, they're the least financially literate and the most likely to carry a balance and pay interest. The credit industry isn't doing anything illegal, they're simply taking advantage of a knowledge gap. And that knowledge gap almost always starts forming long before 18. The teens who understand what's coming tend to step into adulthood with a plan. Everyone else tends to learn the hard way. So let's make sure you understand the landscape before you step off that cliff. There's a fascinating body of research in behavioral economics that explores when and how our money habits actually get locked in. A widely cited study from the University of Cambridge found that money habits in children are largely formed by age 7. That doesn't mean you can't change them. People absolutely do. But it does mean that by the time you're a teenager, you already have deeply ingrained emotional responses to earning, spending, saving, and losing money. Think about the last time you received money. A birthday gift, a paycheck from a part-time job, cash from a relative. What was your immediate instinct? Did you immediately think about what you could buy? Did you feel anxious about spending it? Did you want to save it but have no idea where or how? That gut reaction you have is your financial psychology in action, and it was shaped by years of observation and experience, whether you were conscious of it or not. This matters enormously before 18 because those emotional patterns are still relatively malleable. You are in one of the last windows of your life where rewiring a money habit is genuinely easier than it will ever be again. Psychologists describe this period as having higher neuroplasticity, meaning your brain is still forming pathways and is more responsive to new information and new routines. Adults in their 30s and 40s who struggle with overspending, impulse purchases, or financial anxiety often trace the roots of those struggles back to patterns they developed as teenagers. Understanding this isn't meant to be scary. It's meant to be empowering. If the habits form now anyway, the question becomes, which habits do you want to form? Now, let's get into the actual mechanics. The 3 financial concepts that have the most direct impact on what your financial life looks like the moment you turn 18 and in the years that follow. The first is compound interest, and it works in 2 completely opposite directions. When it works for you, meaning when you're earning it on savings or investments, it is one of the most powerful forces in personal finance. The mathematical principle is straightforward. You earn interest not just on your original amount, but on the interest you've already earned. Over time, this creates exponential growth. A small amount of money set aside at 16 or 17 has more time to compound than the same amount set aside at 25. When compound interest works against you, meaning when you're paying it on debt, it works exactly the same way, but in reverse. A credit card balance that doesn't get paid off doesn't just stay the same. It grows. And then it grows on top of that growth. This is the mechanical reason why credit card debt is so notoriously difficult to escape once it takes hold. The second concept is credit history. Credit history is essentially a financial reputation that lenders, landlords, and even some employers use to evaluate you. In the United States, this history is tracked by 3 major credit bureaus starting the moment you open any kind of credit account. Many teens don't realize that they can begin building credit history before 18. For example, by being added as an authorized user on a parent or guardian's credit card account, with the parent maintaining control. The way you handle credit in those early years becomes the foundation of your score. A strong credit score can mean the difference between qualifying for a car loan, an apartment, or eventually a mortgage, and being turned down or charged significantly higher interest rates. The third mechanic is the difference between an asset and a liability. An asset, in the most practical sense, is something that holds or grows in value over time or generates income. A liability is something that costs you money over time. Understanding this distinction early prevents a pattern that financial educators call lifestyle inflation, the tendency to immediately spend any increase in income on things that feel valuable but actually drain money over time. This isn't about deprivation, it's about knowing the difference between the two categories and making informed decisions about where your money actually goes. So what does this all translate to in real, day-to-day life for someone who is under 18? Let's ground this in concrete mechanics rather than vague advice. The first practical concept is income awareness. Whether money comes from a part-time job, allowance, gig work like lawn care or babysitting, or gifts, understanding exactly how much money is coming in over a given period is the starting point for everything else. This sounds obvious, but most teenagers, and frankly, most adults, have only a rough approximate sense of this number. Tracking income accurately, even if it's irregular, gives you a baseline. The second is intentional allocation. There's a long history of financial educators advocating for allocation-based systems rather than pure restriction. The concept of dividing incoming money into buckets, often described as spending, saving, and giving, has roots going back decades in youth financial education. The specific percentages matter less than the habit of deciding in advance where money goes before emotion or impulse has a chance to redirect it. The psychological research behind this is solid. People who pre-commit to a financial plan are significantly more likely to follow through than people who make decisions in the moment. The third practical mechanic is understanding the difference between a want and a delayed want. This is not the same as saying, don't spend money on things you enjoy. It's about recognizing that many purchases feel urgent in the moment but lose their appeal within days. Studies in behavioral economics have documented a phenomenon called present bias, the tendency to overvalue immediate rewards compared to future ones. A simple practice of introducing a waiting period before any non-essential purchase creates space for that bias to naturally recede. The fourth is having a savings target with a defined purpose. Saving money without a goal is psychologically difficult. Research on goal setting consistently shows that people save more effectively when the target is specific and concrete. This could be as straightforward as saving for a specific purchase, a future educational expense, or building a financial buffer. The purpose doesn't need to be grand, it just needs to exist. Here's what all of this comes back to. The financial world is not designed to wait for you to feel ready. The moment you turn 18, it treats you as a fully accountable adult, regardless of whether anyone ever sat down and explained how any of it works. The teens who arrive at that milestone with even a basic understanding of compound interest, credit, income tracking, and intentional spending don't necessarily have more money than anyone else. But they have something more valuable: a framework. And frameworks, once established, tend to compound over time, just like interest does. They get stronger with repetition, and the decisions they produce tend to build on each other in ways that become increasingly difficult to replicate if you start from scratch at 25 or 30. None of this is about being perfect with money. Financial history is full of stories of people who made mistakes, learned from them, and recovered. But the consistent theme in those stories is that the people who came out ahead were the ones who understood the rules of the game before they were forced to play. That knowledge is what this channel is always going to be about. If you found this useful, consider liking this video. It genuinely helps other young people find this content who need it just as much as you do. And if you want to keep building this kind of foundational financial knowledge, subscribing means you won't miss what's coming next.